So what is an assumable mortgage? Well, a VA, USDA, or FHA loan is what's called assumable. And that means when you sell your home, you can also transfer your interest rate and your mortgage to the next potential owner. That can be a huge advantage in this market because often you have a lower interest rate than today's interest rate. Another frequently asked question when you have an assumable mortgage, what happens if your mortgage amount is a lot lower than the sales price? Well, there's something called a piggyback loan. Many real estate agents do not understand what a piggyback loan is or how it can help you. But I want to give a really specific example. We recently sold a home that had a 2.875 interest rate, right? But the loan balance was $700,000 and the purchase price was over 1.3. So the amount of cash that was required to come to the table was significant. We worked with a lender who is able to provide piggyback loan options. Now, for some clients, they're of course wondering what's the interest rate. Well, in a piggyback loan, the interest rate is 11 to 15%. That may sound high, but understand this, it all depends your blended rate on the proportion that the $700,000 is versus the proportion of the piggyback loan that you're taking, which is that additional value. And so when we studied the blended rate for one client, it still was 4.4%. When you do the math, instead of jumping to the conclusion that you would never pay the higher interest rate, here's what ends up happening. If you took the market rate and the same approximate price point home and just applied all of the money you would be paying in interest, I want you to calculate something called a break-even point. It's the point at which you would take that interest payment and apply it to your piggyback loan to pay it off. It is dramatically advantageous to pay off that second loan and end up solely with the $700,000 loan at the lower interest rate. So make sure you're working with an agent who understands the intricate math and can help you understand the advantages and disadvantages to an assumable mortgage. What are the benefits of assuming a VA loan? Well, there's a few. Lower interest rates if the seller has a favorable rate, reducing the closing costs. This is a big one. Closing costs can be over 1% lower because you're just assuming the loan. You don't have to go through all of the closing costs again. A much easier approval process that does not include an appraisal, right? The appraisal was already done at the acquisition from the other purchaser. So when you're assuming all of the same terms, they're just checking to make sure that your credit and your income are in alignment and your debt to income ratios work. Once they confirm that, it's just getting the paperwork done and then closing on your new home. Do I need to qualify for an assumable mortgage? Yes, they're still going to check your debt to income ratios and your credit score to make sure that they would approve you for the loan. Can I assume a VA loan if I'm not a veteran? The answer is absolutely yes. And so if you want to know all of the details of why a veteran may consider your offer over and above someone who is not a civilian, that is actually military and has VA eligibility, it's important to work with an agent that can help make your offer compelling and so that your offer is accepted over and above the other offers. Typically, when it's a low interest rate, it will be competitive. The difference when you're working with a team like ours that specializes in going out and finding these opportunities off market, we can specifically look in the neighborhood that you want and the interest rate range that you want with the bedrooms and bathrooms. And so then we're approaching the potential seller and bringing them an offer. So that gives you a competitive advantage if you are not, in fact, VA eligible. How long does the VA assumption process take? Well, it's typically 30 to 90 days. It depends on the lender's requirements and who the servicer of the loan is. What happens if the lender denies the financing for the assumption? Well, the buyer has the option of securing alternative financing depending on the terms of the negotiation with the seller. Which lenders allow loan assumptions? Well, most FHA and VA loan servicers are required to allow the assumption. So let's just talk about why they don't want the assumption. If they have an interest rate that is very low, they would prefer to get that off their books. So will they make it a little difficult on you and require you to follow up a bunch? Yes. Is it worth it? Absolutely. For a lower interest rate, it is worth it all day long. And if you hire our team, we will do that follow-up on your behalf and make it easy on you. We do love massive gratitude, excellent reviews, and thank you holiday cards. So feel free. So I hope this answered a lot of your questions about the potential of acquiring a home that has an assumable mortgage. If you're looking to find opportunities in your perfect neighborhood that would have a lower interest rate and meet all of your criteria, we're here to help.